And I'll start and you just kick in.
All right. Put a little less data on there. Make the today look a little more huge. All right. You're live, Dan.
All right. Yeah, hello, traders. This is Dan Gibby, Greg Capra from mastertrader.com. We're in our green trading room where we have live market review, live trading, opportunity, etc. And we've been receiving a number of emails from both subscribers and non-subscribers that they're getting beat up today. I mean, look at this is the S&P 500 ETF SPY. And we have been saying all week long that we need an event to get more confident of a bullish or bearish move. But the spiders have been in an uptrend. It was a 3-day consolidation. Yes, yesterday was a red bar. After attempting to break out this morning in our pre-market review, we gapped down and we were in full caution mode. And we said, it depends what time frames you're trading, day trade, swing, position trading. But for swing trading, there's been a number of stops hit. This gap down and slicing through support here on the daily chart. This support. Our next target, it's holding right here at the rising 50-period moving average around this one. The weekly and monthlies are still okay. So for our longer term ETF investor letter, the weekly and monthly charts are still doing, they're great. So we sent out alerts to our subscribers saying today was the day to leg into covered calls. And what that means is that there's a stall here in the daily. We want to keep our merchandise for longer term gains, but we're selling out of the money call options to put money in our pocket to lower our cost basis. So Greg and I are going to talk about a number of miscellaneous things right now because in no particular order, but people who, just brag about their winners and then they go silent when, the shit hits the fan, so to speak. That's not the way we operate. Master trader methodology is compelling setup, timed with market internals and multiple time frames. And then we properly position size, and then we're just in management mode. We've calculated the proper position size, so if we do get stopped out, we've accepted that loss. When we put our money on the line in trading and investing, of course you're going to have stop outs. We're all about high probability setups, though, and then we just manage in between. So we're going to talk about a couple of money management considerations, what you could have done here. Taking a stop obviously is one of them, but let's first take another quick look here at the other index ETFs. There's the diamonds. You got all kinds of rhetoric out there. I know Kavanaugh, the hearings and confirmation is on people's minds. We've had, let me jump over to the TLT real quick, which is the 20-year bond ETF. So with bonds tanking, the yields are ripping to the upside, which is actually a good sign for the economy. It means that things are ticking and business is picking up. But whether CNBC is putting that fear, saying, 6 or 7 year highs in interest rates, and that's causing people to run for the exits. We know that affects interest rate sensitive sectors like ITB, is the home builders have gotten shellacked with the rising interest rates. We've been watching XLF, which is the financial ETF, which is the beneficiary of higher rates. But let's just keep marching along here because there's many topics we're going to cover. So the diamonds here, we got a daily chart, Dow 30 ETF, we got rising 20, 50, 200. Yes, it's an ugly day also. But this is still in an uptrend. It's higher highs, higher lows, beautiful moving averages, relative strength to the spiders. That was actually one of our positions, the diamonds in our ETF trader. and we sold the out of the money calls, and that position is 100% fine. But if you're trading a smaller time frame, like swing trading, then there's been some stop hits today. And I'm going to show you a slide where we're going to talk about proper money management in a moment, but let's just keep focusing on some of the markets here, both to give you our current assessment for what's going on and, see where the next level might be. So the Qs here, which is the NASDAQ 100, broke out bearish gap this morning in our pre-market review and after the market opened. I noticed the action here, and after 5 minutes of trading, I said, we're in total management mode right now. I wasn't looking for other opportunity, because when you're trading, what we do to make money trading and investing is just turning over our inventory. A stock or option or commodity or currency, whatever position it is merely inventory to us. That's how we make money, by turning over that inventory, similar to Macy's as a retailer, and making money on the profits. So this morning I said, hey, after 5 minutes, I'm totally focused on money management of our existing positions. I was tightening the stops. And again, we'll talk about money management a little bit more when I show you the slide. But this is a wide range bar to major support, the rising 50-period moving average. You can see the volume pickup. So there's some fear here today. This definitely took out some stops. But is this a time to exit your long-term trades? Absolutely not. The weekly and monthly still look great. But again, for day trading and swing trading, it was time to tighten stops. So there's nothing really to do on this pattern right now. It's a wide range bar to support. We need more information. The intradays are oversold. IWM here has been relatively weaker of the indices. So we've been staying away from this one. And I don't know if it's trade wars, the IWM is the Russell 2000 ETF. There's more biotechs, more regional banks, more growth companies that many don't make money. So there's different components. And all right, so that's those are the 4 broader market ETFs that we watch. So Greg, before I pull up the little slide from an old seminar on money management, what would you like to add to what I just talked about?
I don't think there's much more to add, Dan. You covered a lot.
Okay, well then let's jump into money management, because again, we don't want to hear people losing money. I mean, my account's down today. I mean, this is a fact of trading life. We even had some questions of, people aren't going to take their stops for different reasons, whether it's fear, whether it's whatever the case. And my response to that is, that's unfortunately part of the maturation process in trying to follow your trading plan. But a stop to me is your insurance policy. It's saying the trading worked in as originally intended, so you exit to preserve your capital. But now on this slide, let's concentrate on risk position management. And even though I pulled this from an option seminar and it says short option positions, we're going to talk about management of both positions. So, I mean, this was one idea, do nothing. And this applies to the option trading, primarily where we're shorting options and credit spreads, where we put money in our pocket and we're calling or predicting a short-term top or bottom, and we want to get paid through time decay. But when you sell options, if you sell puts, you put money in your pocket and you have an obligation to buy the underlying stock. If you sell calls, you put money in your pocket, you have the obligation to sell or short stocks if you don't have you did not have a slide up. Oh, I thought Greg, it was showing the whole screen, and I do have it up.
You must be showing your platform, not the screen.
Okay, I thought let me check that. So I hit and show my entire screen, but let me check again.
Show the monitor, whatever.
Yeah, okay, I got it. All right, perfect. So this is what I was just saying. You're willing to be assigned at the improved cost basis. That's what does nothing means. If your trading plan says, I'll take that stock at a discount to own it, I'll take that stock to be short at a higher cost basis, that's what this one means. So again, we're now talking about total risk management, because we know, there's some people getting, hurt because they're just getting stopped out, or they're not following their trading plan, they're not taking their stops, they're listening to other people who don't have a plan, whatever the case. Again, this managing winners, this one has to do with selling these credit spreads. We love general objective. If we can get 80% of our maximum gain quickly, we love that. And that's why, don't overstay your welcome. If you're doing this as a speculative trade, where I don't want to be assigned the underlying, I just entered this to make money. One example of that was our Baidu position. We shorted an out of the money call spread 2 days ago, and we've already made over 90% of max gain. So we're out of that position in 2 days. Let me continue here. And then if you're trading stocks, managing winners is also simple and pleasurable. We teach how to use Master Trader Advanced Management Strategies, which is part of Greg's incredible Master Trader Strategies course. And we teach you how to do it objectively with a clear head. And even though that says manage winners, now let's talk about managing things going against you. Like today, if you were long many things, and there's pieces of things that are holding up fine, not the whole market doesn't go down at once. Financials are holding, there's some individual stocks holding, there's some transports, railroads that we're watching that are showing relative strength. But you stop out. That's what I mentioned earlier, what a stop is. The pattern, well, let me back up. We define a stop as the reasons for entering the trade, which is a compelling setup based upon Master Trader Strategies, multiple time frames, has failed. So the reasons for being in that trade no longer exist. Therefore, get out of it. You've already calculated the proper position size, so you have accepted that loss ahead of time. And if you have not accepted it, then that's a problem right there. You're either trading too big a share size, you're afraid of the loss, you have other things of lack of confidence, etc. And you need to come to us and let us teach you the proper way to do this. So we take a stop, protects your capital, protects your mind. And actually, one individual asked us earlier, and they said, hey, Greg or Dan, do you have a plan if you fail to follow your trading plan? And I think that was in the vernacular saying, I didn't take my stop and I'm up a creek, and what do I do now? And I'm sure many people are in that situation. In the green trading room, we don't hold judgment on anybody. We want people to learn when they don't follow their trading plan, because that's tuition you've paid to the market. And so my answer, though, to that question was the following. assess the situation from the standpoint that you are not in the position, even though you are. So think about that. If your neighbor or your trading friend sitting next to you in a room says, hey, Dan, what do you think about buying Microsoft right now? And if you would tell him, are you out of your mind? There's no setup on any time frame. The market internals are horrible. X, Y, Z. Then you should be able to make that same determination to your own position. So, Greg, I'm sure you have something to add to all that so far. You're the expert of position sizing, and I'll then talk about adjusting both for options and stocks once you have anything to add.
It's the most simple thing to understand. The basics of position sizing, as it relates to trading long or short, and the underlying, maybe not so easy with options, but it is the least focused on part of the trading plan for those that are starting out. And it's because it's human nature to focus on the money. And most just don't even look up money management as it relates to stock trading. They go to Google and they type in maybe trading strategies or how to get rich, trading options. They put in novice type messages also, search terms. Right. So the focus is making money, which is all of our focus, of course. But share sizing just takes the emotion part out of it. Not completely, because look, when something's going against you, sometimes it's a struggle to put your face where it needs to be, meaning this is not working. But you need an objective method of determining what isn't working, and what isn't. Clear trading plan is to say, hey, within this trend, it's violated this level, and so now it's time to step aside. And of course, there are those situations that we've all been in where, we've gotten out of a position because it's violated support, and it turns around and goes up. That's going to happen too. But, part of the problem is that most people that are entering where that happens, and they've taken a sizable loss because of it. Well, first of all, they didn't share size appropriately, but they probably didn't enter at the right point in time. I've worked with a lot of traders over the years, and back many, many years ago where, I sat in a trading room with 20 other traders, and at the end of the day would review their trades with them. And probably the most frequent question that I would say to them was, why did you enter it there? Meaning, instead of the pullback to support, it's up 3 green bars. Why did you enter there? Well, Goldman Sachs was on the offer. I was like, who cares? I mean, it went up. So is that a valid piece of information for you in the future to not press the buy button when the technicals say so? That's part of the learning process that everybody goes through, because when something has pulled back to a level of support, it has been experiencing a period of selling. And you watching prices go down. If you're an intraday trader and you're looking at time and sales, you're seeing all these red prints, so you don't, even though you see the reversal and you've learned about the reversal and the bottoming tail and the, the 180 reversals are the different setups that we look at. In the moment, you can't bring yourself to accept what is. So let's wait for a little more confirmation. Oh, it's really going up, then, oh, maybe I'm going to miss it. I better press the button. And sometimes you get lucky and it works out. But, a lot of larger losses happen because of no money management and because of improper entries. But it's all part of the learning process. We all pretty much do the same thing and make the same mistakes. And that's why education is so valuable. If you can learn from me, because I've made all of those mistakes, at least you've got a chance of eliminating some of them. And you probably won't, meaning you'll probably register to you faster than if you didn't get that education, because it'll stick in your mind at some point. Oh, I remember him saying that now, so.
That means similar to telling your youngster, don't put your hand on the stove.
Well, that's, more immediate, once you've done it. But the stock market is a different animal. It's like if it was the same as putting your hand on a stove versus, yeah, that didn't hurt so bad. Or, hey, I didn't follow the rules and hey, things worked out okay this time.
Right. And you mentioned that this morning to the folks that's what you call in your book, one of the deadly sins of you win the wrong way. And then that reinforces negative, bad things. And the stock market's not forgiving, and it will come back to burn you.
Right. So money management is the most important thing. I can show you a few patterns that you could utilize tomorrow, and you understand them in a matter of 15 or 20 minutes. The money management part, its tentacles are in so many things because it gets into your head if you don't use proper money management. It's rationalizing, not adhering to stops, winning the wrong way.
Greg, before I enter any trade, this is personally, and I teach it too, I don't ask myself, how much pleasure is this stock going to deliver to me? I ask myself, of course, reward to risk, probability of setup, this and that, but I don't put on a trade without answering the following question. How much damage can this stock cause me if it fails? So that just illustrates, yes, you do the proper things, and revenue and profits should result from that proper trading plan and approach to the markets. But I'm always focused on the downside before I get excited about the potential upsides. And for example, that's why we don't trade earnings. Yeah, you could have blowout earnings and get lucky on a $20 gap up, but that $20 gap up possibility is not worth it to me because I can get an $80 gap down.
Right. We all make choices as to the amount of risk that we want to take on.
All right, so let's continue with this, and then we'll finish by coming back to the broader markets, and maybe you can add something about the market internals and give an opinion about our plan into the end of the day and the next couple of days on a basis. All right, so adjusting, and this applies to both stocks and options. What adjusting means is you're in trade management mode. You've entered a high probability trade. You're now just taking in the information as the trade progresses. And if your bias is changing, at least in the option world, we teach ways to adjust or overlay different strategies to adjust your net exposure. For example, If we have a bull put credit spread where it's a bullish pattern, we're calling a bullish bottom, and then it had a false breakout, a deep retracement, it's held its stop, so there's no reason to exit. What one of our strategies we use all the time is we say, hey, let's now sell an out of the money bear call credit spread and to convert it into an Iron Condor, because now it looks like it's going to be range bound into expiration. So that's just one example. Another quick example is if a bearish position because of a bullish gap turns totally bullish, we'll convert that position into a covered call. But again, we always make those determinations based upon our bias of the stock while we're in trade management mode. So now, what would be an adjusting position on stock? For example, today, Greg and I in the green trading room, we had a discussion about some various stocks. And the choices are, well, your stop isn't hit, so just leave it alone. You've position size for it. But then we talked a little bit about, hey, if you ever feel in doubt, just lessening your position is an adjusting strategy. So maybe just get out of a third or a half if you aren't feeling as confident based upon the current market environment. And that's one, and I mentioned it earlier, what we did on every one of our positions in the Master Trader ETF investor letter is we were long stock or ETF, and I did the same thing for our regular advisory letter. The long stocks that we had, they didn't stop out. The weekly still looked fine. So we legged into a covered call. That's an adjusting strategy we do all the time when we're trading, when we start with stock. So Greg, any comments on that? And then we'll go to the last one.
Well, for myself, if I've share sized for something, I let it pretty much run its course.
All right.
If I've added to a position, that means it's working. And then, of course, that doesn't mean it'll continue to work. So in that scenario is where I'll start to cut a position size down. If I've added to it and then I become uncertain about it, because now I'm over, I've over position size. But if it, like today, like this stock, this PRSP, at the end of the day yesterday, I was like, that is not what it's supposed to do. But I share sized it for a certain level. And, I don't know. I just being open and talking about what I was thinking at the time, was it rationalizing to say that topping tail is kind of okay? And I thought that, and I said, the market was a negative day. If it was a positive day, that tail wouldn't be there. However, I know historically that kind of a close out of a base, a lot of times it doesn't work out. But I'd said, just let it do what it's going to do. And today, when it went down as the market sold off, it was, missed the stop by 2 to 3 cents and rallied back up into the gap fill. And I thought to myself, should I let this thing go now? And I'm like, no, it looks good. And then it went down and it hit the stop. And, that stock, as certainly as I could be, and I'll say that with a
2550,
that stock is going to go up, but it's not doing it right now.
Right.
So I got stopped out, and I keep it on my watch list because I think it was a victim of the market versus, just a bad setup. Whereas, sellers, just think about it. If you were looking at XYZ and you're bullish on it and thinking you want to buy it and you see the market down 300 points, are you going to wait or are you going to jump in front of it? And that's what happens.
Right.
buyers just go on strike and wait to see. And when that happens, whoever wants to sell is in control and prices fall more than they typically would. And, so we'll see. And we'll see tomorrow what this market does as far as coming back. This was a nasty crack. What time is it? It's almost 3:15. And so far that tail is being eaten. And last year, this market was notorious for reversing nasty days. And so we'll see where this one goes, but higher time frames, longer time frames are still bullish. So we'll see what happens over the next, tomorrow's the end of the week, right? I think,
Yeah.
yes. So we'll see where this all goes and into next week and assess it. But this is, I'm going to say a shot across the bow. Don't be complacent about it, because while higher time frames are in uptrends and still look fine, it doesn't mean we can't have a 5 or 6 or 7 or 10% correction and still be in a bull market. And, whatever you own is getting, shellacked, but good. That happens a lot.
Right. And, the diamonds here is the only index ETF that we're long, that we've been trading. The other, we love selling options. We were pounding the table on when the markets were coming out of this big rounding bottom on the 200. But we've been saying all week long, as you said, this is not the time to push the envelope. Even last night, you did a video and review of the market, sent it to our database, and said exactly that. Be selective. Wait for the event to give us confidence. That's what prudent traders like us do. You aren't forced to trade every day. You only trade when we have high probability setups.
That's it. And what I've been seeing and saying is that things are correcting here. I don't know how far it's going to go. So let's just wait and see what it's going to do. And in the meanwhile, while we see decent setups, just trade smaller.
Right. All right. So yeah, let's conclude with just looking at the daily chart here of the indexes. Here's the spiders. So this bottoming tail shows you that we've already recovered 40% off the day's low. So that's a nice bounce. It also approached the 50 MA, this prior support. So as of right now, we're in a wide trading range. Diamonds is the strongest, still uptrend, higher highs, higher lows. Qs we looked at, the bounce isn't as big because this tail isn't as big, but we're also in a wide trading range. Support here, resistance there. So this is the environment, like you just said, trade smaller, be more selective. IWM, we just have no interest in right now, nothing to do there. So how did your market internals look, both for day trading and swing trading? Let's look at the 15-minute charts. So for day trading, IWM here, this is a bullish retest pattern. That doesn't mean we're going to trade it. Diamonds here, see, look, buyers came up right in the gap fill area with a bullish daily. So we have 45 minutes to go. If this would come back and set up a higher low, then that might be a day trading opportunity. Same with spiders. And finally, same with Qs. So right now it had a nice bounce, and we're waiting to see. It looks like that's the low of the day based on these 15-minute charts. Now we're just going to step back and see what happens here on this next retracement, and then see what happens on the daily chart that we just looked at. But Greg, any thoughts on that and or market internals before we conclude?
Well, breadth is gotten oversold a bit. It's not as an extreme yet, and sentiment is still neutral, which is a little surprising after a big wide range day like this, which tells me until the idiots step on the gas that they believe the market's going lower, it probably will. Once they're all in, it'll be time to buy for sure.
Okay, so I mean that makes perfect sense to our subscribers, but why don't we just add a little bit of flavor to that for the folks who don't know how we use techno fundamental analysis. So what Greg's saying is, when we're looking at the market internals, the two of our most favorite ones are the put call ratio and the breadth. He says breadth, because of the sell-off, obviously, has gotten more oversold, but it's not at a bullish swing turning level yet.
Well, it actually is. It could go further, but sentiment is not yet. So they have to be in alignment to pay attention to those internal gauges.
Got it. So let me just add a clarifying note on the sentiment. We look at the put call ratio on various time frames for day trading or swing or even position trading. And when the market sells off, fear is rising, volatility is rising, and what we're looking for is what we call the wrong way option traders to be loading up on put options. When the put call gets so drastically high, that's a indication that all of the bears are all in. And historically, those turning points, they do that at the absolute worst times. So Greg is saying that when we get alignment, that those wrong way option traders are all in on the bearish side, then we are going to have a bullish warning light go off. Hey, get ready to go long. Does that mean buy? No. It means that now we're going to look at whatever index ETF has the best bullish pattern on multiple time frames, and that's the one we're going to enter with the bullish stock and option trades. And when we get extremes like this, I love selling out of the money put spreads, because with the volatility rising, we're going to get paid more money for selling those puts. This is the VXX, which is a volatility ETF. And you can see the volume today. It had a big bar here. So, volatility is rising also as markets are selling off, which is normal. So I hope that clarified it for our non-subscribers. And unless you have anything else, I think it's a wrap.
Oh, that was a good review. We've got some visitors there on YouTube, and that'll be there for others to watch later on. And hopefully it helps everybody, because days like today are can be a little unnerving. And of course, some are taking some sizable losses that have never considered money management, and or to have a method. So everyone has to realize, look, unless you have a method that you've used for a while and have confidence in it, you are truly, in the learning process. And I hate to say that it's normal, but it is, to be indecisive and to take some losses that you never expected. It kind of comes with learning the markets. And so, just take that to heart and say, you know what, that was some good advice that maybe I can sidestep getting, a black eye one day by learning how to do this intelligently. Because when I started out, I didn't. All I did was see dollar signs and swung for the fences. And, there was some painful experiences that came with that. So You know, if you can avoid that, that is truly, you know, being smart. When you can learn from someone else's mistakes and experiences, you know, that is tremendous. So.
And then, we get emails all the time, people saying, I've tried so many other services and, I won't even get into that nonsense of their bad experiences, but they're like, oh my God, I'm so happy I finally found you. I wish I did 10 years ago.
Listen to this in closing. I forwarded Dan, actually copied him so he could read it, but I had a new subscriber just subscribed at the beginning of the month to the advisory letter. And she said, Greg, I heard you doing a webinar recording and you talked about how it is possible to make money, with some of these people that are out there that are, promoting the latest, greatest indicator or their alert services or whatever. And that you said that, without a plan, it's dangerous. And they said, you know what? You were right. I made a couple of $1,000 and continuing to follow them, I lost the 2,000 and another 5. I wish I listened. So just listening to something that may sound spot on, common sense, warning, be careful, learn what you're doing, doesn't mean you'll do it, because the pot of gold is shiny and it's calling you. And unless you heed the warning that, what can happen, and today is a perfect example of how you can get into big trouble. Learn what you're doing. Nobody out there that has a profession didn't learn it from someone else that had some experience, or you went to school, and the markets are no different. So don't shoot from the hip. It's your money. And
yep. And folks, feel free to take a trial to our green trading room. We're actually in there, live. We're just broadcasting on YouTube, but the main purpose was for our subscribers. And you can go to mastertrader.com/green trial for a free 3-day trial. We have a no-brainer $7 trial to our advisory letter. Check that out on the web, and then subscribe to our YouTube channel. Greg and I do a Master Trader live show every Wednesday at noon for an hour on very exciting and educational topics where you're allowed to ask questions in real time also. And we're here to help you objectively meet your trading goals in trading and investing to create wealth. And that's all I have to say now.
Have a good one.
All right. Thanks for listening. And now we're going to be back in the green trading room focusing on the afternoon session. Take care.